We now know that profit does not equal cash, and that's because of the timing differences between when cash comes into the business and when we recognize income, and when cash goes out of the business and we recognize expenses. Let's take a look at an example of income and when cash comes at the time of the sale, after the time of the sale, or even before the time when we recognize income. We had the example before where we earned $100 of consulting revenue. And we showed that we were paid when we earned that revenue. And to show that cash can come in at the time that we earn revenue, we debit cash $100. We debited cash $100 and we credited consulting revenue $100. If we had done the consulting and the client pays us in 30 days, we would still recognize $100 of revenue, but instead of debiting cash, we will debit accounts receivable. Accounts receivable is an asset. Ultimately, we hope that it's going to turn into cash. Imagine that 30 days later, we receive a check from the client, and in fact, they've paid the $100. At that time, we would debit cash $100, and we would credit accounts receivable of $100. And you see now, they don't owe us anything. This nets out to zero. Cash is $100, consulting revenue is $100. But we didn't recognize consulting revenue again when the cash came in. No, we certainly debited cash and credited accounts receivable. So we've taken a look at when cash goes up when we recognize income. We've seen when cash corresponds to it coming in after we recognize income. Let's take a look at if we were to receive the cash before we perform the consulting services. Imagine that this client wants me to do this work and it's a long ways away and I don't know if they're going to pay. So I ask, you're going to have to pay me up front. So 30 days before I do the job, they actually send me a check for $100 cash. Have I done the work to earn the revenue? No, I've not earned it. Do I have claim to that cash? No. In fact, the client does. Because if I don't perform my services, they have a claim to come back and say, give me back my $100. So we have a liability. A liability, it's another person's claim. That client has a claim of $100. And we have a liability account called unearned revenue. And I am going to credit that for $100. At the time that I actually perform the consulting revenue, I show up, I do the work. Now, they've already paid me, so no cash is going to exchange hands. Here's what happens on my books, though. My unearned revenue, they no longer have a claim to that $100. I debited $100, and I've earned the revenue. I credited $100. So there's no liability. 30 days prior, my cash went up $100, and now, after reducing this liability, my consulting revenue, I have earned the $100 of consulting revenue. So you have seen with these examples that cash can come in before, at, or after we earn income. In fact, there can be variations of that. Maybe they partly pay me the day and pay part later. Or they've put a deposit before and they incur more work and I bill for that later. So cash can be coming in at various times. But this is also the reason why profit does not equal cash.